which financial accounts do I have, which ones are the best, which ones do I recommend that people open. And I feel like, honestly, at the end of the day, a lot of these are going to be pretty basic. The important thing is that you look at the terms and conditions of each of the accounts and make sure that you have the best one for the time being, given your goals and how much money you have and where you're at financially. And don't be afraid to change accounts at least once or twice a year. I don't think that that's doing too much. I think it actually makes sense at least once or twice a year to review all of your accounts and make sure that they're still the best account for you, for your goals, for the money that you have in that specific account. So that's just my quick little spiel about like why it's okay to change accounts, and not even that it's just okay to do it, why you should actually be trying to change your accounts. And if you can't find anything better than the one that you have, great. Well, then you keep the one that you have. But you still got to do a little bit of research and comparison with other accounts out there at least once every 6 months, I would say, or at least once a year. But definitely 1 to 2 times a year is what I would say I feel comfortable with. And doing more than that is probably doing too much. But not changing at all is definitely slacking, not doing enough, because there's always new accounts coming out, new institutional offers, products, services, and it's your job as a consumer to kind of keep your eye out for what's better than what you already locked into, especially when it comes to the first two accounts on the list, because they're traditional kind of bank accounts, or like accounts that you would get at a credit union or a bank. And these tend to be the kind of accounts where majority of people do not change the account. Once you have it, that's it. Like once you open the account, you kind of basically keep that account, and you just don't. For some reason, there's something called stickiness, where once you open a bank account, whether that's like a checking account or a savings account specifically, most people do not change the account. Once they have it, that's it. That's the account that they're going to have. They generally keep it, for years and years and years. And they don't even think about, like, is this still the best account? And when it comes to the checking account, is the worst, because most people never change their checking account. Once they open it, they just kind of keep that account. And a lot of people, especially in the US, open their checking account for the first time because their parents open it for them or with them, which means that you probably still have the same checking account that you opened with your mommy or daddy back when you were your teenager or a preteen. And now you're a grown adult in your 20s, 30s, 40s with the same checking account that you opened when you were a little teenager with your mommy and daddy. It's ridiculous, because it's probably not the best account for you anymore. So we'll start with the first account, which is a checking account. But my favorite top type of checking account is a interest bearing checking account. If you have a checking account that does not pay you any interest for parking your cash in that checking account every month, or setting up your direct deposit into that checking account every 2 weeks or every month, you're slacking, you're failing, because checking accounts are basically a shoebox for your money to sit in. And that means it's not growing. It's not growing at all in value. And inflation, we know this. Every single year, inflation takes away a couple of percentage points of the value of your dollars. So if it's sitting in a box, not growing, it's not doing anything to fight against inflation. So that's unfortunate, because a lot of people do have money coming in and out constantly out of a checking account or into a checking account. So I would say you definitely want to have an interest bearing checking account, not a regular traditional checking account. And if you've never heard of an interest bearing checking account, then this is your homework. This is your to-do list right here. Open an interest bearing checking account and switch from your regular checking account to the interest bearing checking account. Some interest bearing checking accounts will pay 0.05% interest. Some will pay 0.10% interest. I currently right now have an interest bearing checking account with Ally Bank. I love them. They're online only. There's so many perks and benefits to having an interest bearing checking account with the Ally specifically. And this is not sponsored or anything like that, but I'm just saying it because I personally use it. And I have a checking account set up for both my mom and my dad. And the reality is they are very generous with the different features they have. So you get a reimbursement of up to $10 for any ATM fees that you use throughout the month. There are no fees, no minimum deposits required, no annual fees, no maintenance fees, no monthly fees, no overdraft fees. I mean, there's so many things that are better with this account than most typical checking accounts. And on top of all of that, you get paid 0.1% on your dollars that they're sitting in that checking account. You can set up spending buckets. It's not called a checking account. Technically, it's called the Ally spending account. which is a little thing, but even though it sounds minor, I really like it because a lot of people still call it checking accounts, and we don't even write checks anymore. The reason why those accounts are called checking is because back in the day, when you would to pay for something, you would write a check to pay for stuff. But nowadays, most people either use a debit card, they use tap to pay, they use their Apple phone, their Apple Watch, they use, Google Pay, Samsung Pay, whatever. So most people are not paying with a check anymore. So because of that, Ally has changed the name of their account, and it's now called a spending account. They don't really connect it to checks anymore because it's 2025 and beyond. People don't write checks. So I really respect how like forward thinking Ally Bank is, and how they're really constantly trying to think about meeting customers where we are today and not just keeping some outdated system in place. Even just the names of the accounts, why do we keep calling it that if it doesn't make sense? So I don't know of a lot of other banks that are like promoting that they're like changing their practices and even naming the accounts differently to reflect modern times. But I commend Ally Bank for that. I really love their checking spending account. And I also really love the fact that they allow you to put your money into different buckets. So you can kind of budget out your money into different buckets within your account. So that's really great if you have specific little, goals or categories for your money and you want to split it up inside of the spending account. You can do that really easily. You can do it inside of your savings account with them. That's a really nice feature. But so that's one of the only ones that I know that has so much flexibility is the Ally spending account. But I know that there's so many others that also offer interest bearing accounts that are checking accounts. So that's one that I would definitely say switch over. It's very easy to find an interest bearing checking account. What I will note though is that this is something that works for me because I don't really use cash. I very rarely have cash on me. I don't really make money as cash, and I don't really pay for stuff with cash. But so if you are the kind of person who works in a cash heavy industry, maybe you're in the restaurant industry, in the service industry, and you get a lot of tips, that means that you're going to probably want a different type of account that's not only online, because it's really basically impossible for you to put cash into the account since they're online only. So you might need a more traditional institution that allows you to take your cash to the ATM machine and deposit it. I don't have to deal with that, so it's not really something I have to worry about. But if that's you, keep that in mind, that some of these online or digital only banks that offer the best features and the best rates, they probably won't be the most convenient for you if you're looking to deposit cash into an ATM every week or every month. So that's interest bearing checking account. The second one is a high yield savings account. I have been on my soapbox about the high yield savings account forever and ever and ever and ever. There's so many reels on my Instagram. There's so many videos on my YouTube channel where I talk about the high yield savings account, why you have to have one. If you're saving money today, you need to put it in a high yield savings account. Again, we're going to go back to inflation. Every single year, you have a dollar, it's going to be worth 97 cents, 96 cents, depending on the inflation rate that year. So you have to try to get it back up to a dollar in value. And the only way to do that is for the institution that you are saving with to deposit that money into your account and make it go back up to 100, right? So it's really important to keep that in mind. This is true for any amount of money. You don't have to have $100 or $1,000 for this to affect your money. You can have 10 cents in your account. It will be worth less because of inflation. Inflation affects every single unit of currency that we have, all of our money, every account. So it's very important that we keep that in mind, that when you're looking at how much money you have after 1 year, it decreases in value. That's true for your investment accounts. That's true for your bank accounts. That's true for anywhere you have cash. So because of that, you want to try to catch up. So with the high yield savings account, the interest rate on the account is generally going to be similar to or better than the inflation rate. So if inflation is about 3 or 4%, you can expect to get 4 or 5% in your high yield savings account. That way, you're at least undoing the damage of inflation. So you have $100 in your account, a year goes by, it's now worth $97. You get a 4% interest rate on that account. So after a year, your account goes back up. Now you have $101. So it basically allows you to just grow it a little bit or just keep it at the same value. So at least you're not losing the value of your money. Now, if you have a regular traditional savings account, that is not going to help you to combat inflation. It's not going to keep your value of your money. Your money is going to lose value every year because regular, traditional savings accounts pay tiny little interest rates, like so close to zero, that when inflation is 3% or 4% and you're getting 0.01% or 0.05%, is not even touching the amount of inflation that has affected your money. So you have to look for higher yield, higher interest accounts. So when it comes to savings, that's going to be your HYSA, which is an acronym for high yield savings account. The higher the APY, or which stands for annual percentage yield, the better the account pays. So if you see a 2% APY on this high yield savings account, and this other high yield savings account over there has 4.5% APY, if everything else is the same, get that 4.5% because it's more than twice as much of the value of the other one in terms of what you collect in interest, right? How much money the bank is literally just going to deposit into your account. I wish I knew about the high yield savings account earlier. And the one thing I will say, actually, my good friend Amanda, shout out to Amanda Savignon, she was the photographer for the book cover, that for my cover of my book, where we did the book cover photo shoot together. And she's an incredible, incredible woman. Love, love, love her. She commented and said that she had a high yield savings account that was paying her 4%. And then now she noticed that it went down to 3.6%. And she was wondering what I would say, like, withdraw everything and move it over to another account paying 4%. Like every time this happens. And she said, I feel like they change so often, so fast. Like, what's up with that? So this is such a good question, and it's such a good point because it is going to continue to happen. This is not like a one-off thing that happened to Amanda and that she's the only one dealing with it. It's going to continue to happen to all of us all the time because the Federal Reserve Bank of the United States, which is the big kahuna bank that kind of decides all of, the monetary policy that kind of goes on, that all the other banks basically under the Federal Reserve Bank are going to have to follow what they do. So because of that, the Federal Reserve decides on the interest rates and what they are and when they change. So there is something called the FOMC, which is an acronym for the Federal Open Market Committee. It has, I think, 12 or 13 members, and they sit down together 8 times a year to have these meetings, which are very big, important, like serious news in the financial world. But probably everyone else who's not really into finance like that never even heard of these people. They don't even know what the Federal Reserve is. The recent headlines that the chairman of the Federal Reserve, whose name is Jerome Powell, was visiting with Trump to take a look at the facilities that the Federal Reserve is putting together now, is like updating the facility. And that whole situation went viral. But I know a lot of people were saying, who is this man? Who's with Trump right now? Who is that guy? That's Jerome Powell. He is the chairman of the Federal Reserve, which means he's the leader of that group, the FOMC. So all those members in that group, they meet 8 times a year to decide what is the monetary policy going to be. Are they going to increase interest rates? Are they going to decrease interest rates? And they make those decisions based on a whole bunch of nerdy ass statistics and indicators like GDP. They look at inflation rates, which is the CPI rate. They look at different employment rates or unemployment rates. They look at like how the different indicators are moving. For example, the stock market or government yields. They look to see like treasury yields, how are they doing? And all of these different numbers, they look at how they interact together and how they play together. And then they try to decide, is this creating an environment where consumers are spending too much and we need to pull it back? If we need to pull it back, then we need to make sure they stop borrowing and stop spending. And the only way to stop borrowing and stop people from spending is to increase interest rates. Because when interest rates go up on credit cards and mortgage loans and personal loans and auto loans, people go, oh, I don't want to borrow right now because I'm going to pay a lot in those interest rates. So if the economy is doing too much and needs to reel back, then the FOMC decides together in these meetings that they're going to increase interest rates to cool down the economy. Now, if the economy is really slow, if GDP is low, if the market and treasury yields and the different employment, the market of like the job labor force, like all of these things are not what they expected or where they thought, and they think that they need to boost the economy, then decrease interest rates. They'll drop rates because by dropping rates, people will like that they can get a mortgage lower, they can get a car loan lower, they can get credit cards with lower interest rates, they can take personal loans out with less interest. Lower interest means people are going to be more likely and more willing to borrow and spend on credit. Because of that, it will boost the economy because consumers will go out there and start buying a car, buying a house, borrowing on credit. And so that is how the FOMC uses changing interest rates to create the response and monetary policy that basically leads to either boosting or harming the economy. It's pretty simple. They literally go into a room, they have these meetings, and they look at the numbers, and then they decide is going up, is going down, or is not going to change. The FOMC under the leadership of Chairman Jerome Powell, has not changed interest rates since December of 2024. It is currently about to be August 2025, and they have not changed interest rates yet, which is really rare because usually interest rates are changing at least a couple times a year. Now, based off some of the stuff that they've said in press releases and interviews, some of what people have gathered is that there are going to be two major changes in 2025 before we get to 2026. The two major changes are going to be drops. They're going to be decreasing interest rates by like about 0.25% each time. So altogether, it'll be 0.05% less by the time 2026 rolls around. So what does that mean? When they lower interest rates, all the other banks under the Federal Reserve also lower their interest rates. They follow the big kahuna bank. So if banks are looking ahead and they're thinking the next time the FOMC meets, they're probably going to lower interest rates, then they're going to get ahead and they're going to start lowering rates. They're going to start preparing for that. So what Amanda's describing, that her bank went from 4% to 3.6%, that's normal behavior in an environment where interest rates are expected to drop. And they are expected to drop 2 times in 2025. Now, that means that when they officially do drop interest rates, everyone's going to start seeing, all the banks with high yield savings accounts, interest rates are going to start going down. So to her question of like, what should I do? Should I change? If they keep changing this often, should I keep hopping around, take my money out and go to this next bank to try to chase a better rate? I would say it depends. It depends on a few different things. In my personal opinion, I would not change it for a difference of like 0.25%. If it was more than that, I might change it. Why? Because it's only going to affect your money. But let's say 0.25% is the change. That's $25 on a balance of $10,000. A lot of people don't got no $10,000 sitting in their high yield savings accounts. Most Americans don't even have $1,000, let alone $10,000. So we're talking about differentials of $2, $4 over the course of a year on $1,000 balance. If you really seriously want to change your username and login, take out your money, reset up a new account, transfer the money, do all of those things, and if you have it linked to any other accounts, like a checking account, or if you get deposits into this account through work, you got to change and update all of that too. That could be a hassle. And you're doing all of that for 0.25% interest change. For me personally, it's not worth it unless I got a 6-figure balance in my high yield savings account, right? Which I do not keep. Usually I don't keep more than $30,000 or $40,000 in my high yield savings account, because I don't spend more than $30,000 to $40,000 in a couple months. And so my savings account is really just for looking for 3 to 5 months ahead. So in that case, I would say you should only really change if it's a significant interest difference. In her case, going from 3.6% to 4%, that's a difference of 0.40%. Okay, that's twice of what I'm talking about here. So that would be, $40 on a $10,000 balance. It starts to kind of like, make a little bit of a difference at that point. If you have, if you have $20,000, $30,000, now we're talking about hundreds of dollars instead of just $3 or $4. So in that case, I would say that's worth it to change, because your gas money, your groceries, that could be a birthday gift for your friend. Like, now we're talking about money that actually can do something for you in the economy. $30, $40 is something that can actually, you can use it, versus $2.50 or $4 that might not put a dent on your finances or fill up your gas tank, right? So I think personally that if you have a really high balance in your high yield savings account, then it matters. And if you have an account where you don't really connect it to any other accounts and you basically just save up money, then it's relatively easy for you to change it, and you don't have to reconnect it, re-update your job paperwork so they can have the new information of your bank account. If you don't really connect that or link that account anywhere, then that's even another reason why it might be easier for you to change accounts, because it's not really that hard. So I would say if it's not a hassle and it's going to make a difference financially, like, not just $3 or $4, do the math on an annual basis on the account that you have, the account balance that you have, and see what the math looks like. And if it's worth it, change the account. I just said it when I started this video, change your account at least once or twice a year. Don't be afraid to do that. But if you're changing your account every 2 months, you're doing too much. You're doing too much. 1 to 2 times changing per year is perfectly fine. If you find a better account with a higher interest rate or with better terms, more flexibility, less fees or no fees, Yes, be my guest. Go ahead and change your account. But don't think that every time there's a 0.1% increase somewhere else, that you have to change your whole account to go over there and chase that 0.1%. In the grand scheme of things, how much money are we talking over the course of a year? So just, do that math, figure out your account balance. Is it worth it? And is it a hassle? All those things combined will let you know if it makes sense for you or not. In my case, I've changed my high yield savings account at least once or twice a year for the past 3 or 4 years, because I've gotten to the point where I'm up to like 5% right now, which is a big amount of money when I'm holding 40 or 50 grand in cash in my high yield savings. We're talking about $300-400 every single month. So yeah, that adds up. All right, so far I've done interest bearing checking account and high yield savings account. We're about to get to investments next, but let me check these comments. Fawad said, hello. Hey, Fawad. Thanks for being my first comment on YouTube. Demetrius Parker said, excellent info, Ms. B. Thank you so much. I'm out here just trying to spread the good word. A lot of people had questions about these accounts. Mark said, it's a surprising pleasure seeing you live on this weekend. Can you explain to me how money market accounts work? Yes, Mark, I will definitely talk about that. I think that one of the confusions around savings accounts is that people think there's just a savings account or a high yield savings account, but there's actually 4 or 5 different types of savings accounts. And one of them is the money market savings account. Now, there's a completely different type of account, which is an investment account, a brokerage account, where you can put money into something called money market funds. That is not what we're talking about here. Completely different thing. They're both called money market, but one of them is a money market savings account at a bank or credit union. The other one is a money market fund inside of a brokerage account that holds bonds inside of it. That basically is a very conservative, low interest bearing investment. That is not, again, we're not talking about money market funds here. That's separate, and that's for investing accounts. We're talking about a money market savings account, which is basically a hybrid type of account that allows you to have the benefits of saving your money, adding it up, and getting a guaranteed fixed interest rate on an annual basis. So they'll tell you the annual percentage yield, or APY, for your money market savings account, just like you would know for a regular savings account or a high yield savings account. Now, generally, the yields are going to be a little higher on a money market savings account, similar to a high yield savings account, maybe just a little lower, but comparable, because money market savings accounts don't let you withdraw money as many times as you could in a regular savings account or in a high yield savings account. Those types of accounts don't limit how many times you can withdraw money. But a money market savings account comes with a certain number of times that you can withdraw money. And after that, you're going to either get charged a fee, or you cannot withdraw the money. So it's very important for you to know it has limited withdrawal feature, so that you can specifically leave it there and keep saving it. But you still have like 6 times that you can withdraw money throughout the month. So roughly like once a week, without like breaking the rules of the account. Now, if you just want to keep saving money and you don't want to take any withdrawals out, you don't want the account balance to go down, you only want it to go up, then there's another special type of savings account called the certificate of deposit. And that one allows you to freeze the account, put the money in, and only let it grow. And you can't withdraw money out until it unfreezes, which is at the end of the term. That could be 12 months, that could be 18 months, that could be 24 months. But it's frozen. A money market savings account is not frozen. It's just limited to how many times you can withdraw. Usually, I would say like 4 to 6 times is usually the number, depending on which bank or credit union you open the account with. So that's kind of the money market savings account in a nutshell. Some money market savings accounts even offer you a debit card. So if you do need to make a withdrawal or spend from it, you can, which is weird. It's kind of like the debit card is usually only a feature of a checking account or a spending account. But in this case, they kind of merge a little bit of both of the features and then limit the number of times you can withdraw money. So that's pretty much what it is. It just has slightly different rules and features than a high yield savings account. My absolute favorite is going to be the high yield savings, because it doesn't freeze your money. You can access it at any time. The interest is much higher. So for me, it comes with all the perks. And the only downside is that when the FOMC and the Federal Reserve does decide to lower interest rates, if you locked the money in a CD, doesn't matter when they lower interest rates, your CD interest rate is locked in place along with that money. So if you get a 12-month CD right now and you lock it at, let's say, 5%, well, then it's going to be guaranteed that for the next 12 months, you have that 5% rate. Even if the FOMC meets next week, which I think they literally are meeting in like 4 days at the end of July, they're going to meet and have a meeting. And if they decided to announce that interest rates are going down, you are still guaranteed that 5% CD interest rate. So that's the nice thing about a CD, is that it locks the interest for that time period. Even if interest rates change, yours won't. So during a time like right now, that we don't know exactly when interest rates are going to drop, but we know they are going to drop, that's a nice time to kind of take a chunk of savings and lock it in a CD, because then you can guarantee yourself that high interest rate before all the high yield savings accounts start lowering rates when the FOMC decides after their meeting to lower interest rates, right? The Federal Reserve. So this is all kind of stuff to keep in mind, but not to stress you out too much, because it's really not that big of a deal. At the end of the day, we're talking about savings, which should be just for emergency and or big goals that you have. And we're talking about interest rates that are pretty low. Anything below 6% shouldn't be worth so much stress and anxiety in your situation, right? Now, the third account type, so we talked about interest bearing checking, high yield savings. The third one is going to be a retirement account of some sort. My favorite two are the Roth IRA and the 401k. I have both. And I think that you have to have this type of account because of the interest rates that we just talked about. In the interest bearing checking, you're probably going to get 0.1% if you're lucky, or maybe 1%. In a high yield savings account right now, the high is probably about 5%. In an investment account on a 5-year, 10-year basis, we're talking about an average of 9 to 12%, depending on what investments you select inside of that account. That is way more money. And if inflation is 3 or 4%, getting 9% or 10% allows you to still keep a good 7% after inflation. So that's what you have to consider. Even when you look at a high yield savings account or a CD and you see 5%, you think that's really great. But remember that after inflation, 3% or 2 or 4% gets subtracted, you're really only getting 2 or 3% total after you subtract inflation. So that's why investment accounts matter so much, because the return that you get in an investment account over the long run allows you to actually still have a sizable amount of gains in your account, even after adjusting for inflation. When you hear adjusting for inflation, that means subtracting the inflation rate as a percent from your return or your performance as a percent. So if this year your investment account went up 7%, but inflation was 3%, then 7 minus 3 is 4% is what you actually grew your account by. That's why inflation sucks, but we have to consider it, and we got to basically keep it in mind when we're opening these types of accounts. So if you don't have a Roth IRA account for yourself for investments for retirement, or your job doesn't offer you a 401k or 403b, you got to start thinking about, okay, how can I take my income that I earn through whatever work I'm doing and take a little big piece of it and start putting it aside for my future for retirement? My favorite way to do it is a Roth IRA, but you also have your traditional IRA. You also have a solo 401k if you're an entrepreneur or a small business owner. If you have a job that offers it to you, 401k, 403b, SEP IRA. There's a lot of different types of accounts so that are specifically for retirement, that give you tax advantages for retirement, and that will allow the money to grow and grow and grow over time as you approach traditional retirement age. So I would generally say 100% should have these accounts. Everybody should have at least one retirement account so that they know that they're putting something towards their own retirement. Um, that's just, of course, my opinion, but I think it's very important to be prepared for retirement. Josue Tapia, welcome back, Josue. He said, I'm keeping my savings in 3-month CDs right now, higher yields, plus it prevents impulsive buying. Yes, Josue, I agree with that. I think any money that you put in an investment account or in a high yield savings account or into a CD should be money that you're not really planning to use. And if it's in a CD specifically, then you really can't use it because it's frozen. And if you take it out, you're going to have to pay a penalty. So it sucks because then you're going to literally be losing money instead of making money. So that's why I think the CDs can be great. If you do 3-month CDs, it's nice because it's a short enough time that, you don't have to worry too much. If something happens and you need the money, you can access it within 90 days. So it's not like locked away for 18 months when you can't access it. That's a lot of risk because a lot of things can happen in your life within 18 months versus 90 days. So I really like that strategy that Josue talked about. All right, let me take a look at Instagram. Not a lot of y'all on IG right now. I guess it is, Saturday afternoon. People are out at the beach hanging out. This morning, actually, in my building, they had a Pilates event for all the residents, and it was like themed for Cowboy Carter for Beyonce. And it just made me think, like, This is another one of the reasons why I love that I rent an apartment and I don't own a home. Because if I own my own home and I wanted to go to a Pilates event that was themed around cardboard Carter, I would have to host it. I would have to plan it. I would have to hire someone to show up and decorate and play the music and do the Pilates workout. I didn't have to do any of that, y'all. I just woke up and I went outside and they were playing Beyonce and doing Pilates. And I was like, this is so cute. That's the perk of living in an apartment building when they do stuff like that instead of me having to do all that work. So for somebody who's like very social and I renting is wasting money and I'm so tired of that argument. This is an aside, but my partner and I, we both have a built rewards credit card. We use that credit card to pay the rent. And this is not sponsored or anything like that, but it helps us a lot because every time we pay the rent, we get all of these points on that credit card. And then we can transfer those points and use them to buy flights, to pay for hotels when we travel. And this year we've traveled a lot this year. We went to Davos, Switzerland for the World Economic Forum in the beginning of the year. We went to Cartagena in Colombia with my good friend. We went to Hawaii for for Jamil's birthday. I traveled to Puerto Rico for my friend's bachelorette and also for the Bad Bunny concert. I feel like we've done a lot of trips this year. And again, all of those points and miles add up to being something that actually helps you save money when you travel. So it works for us. But I know a lot of people are like, no, 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 we gotta buy and pay a mortgage. It's like, okay, you know what? Different strokes for different folks. If my company matches 4%, my contribution should be 4%, right? Also, is it okay to set it as after tax? If you set it as after tax, that's a great thing because what ends up happening is that you get the taxes out of the way now when you put the money into your 401k so that when you go to retire and you want to take the money out, you're going to look at that money and you're not going to owe taxes on it because you already paid the taxes and put the money in after you paid the taxes into your account now. So I really love after tax as much as possible. So my 401k is after tax. It's a Roth 401k and my Roth IRA, which I max out every year and convert to I max out the traditional and then contribute instead of basically what's called a backdoor Roth IRA, so I can actually put money into to a Roth IRA every year. Because after like a certain level of income, you cannot contribute to a Roth IRA anymore. But there is a loophole in the taxes that allows you to contribute it to a traditional IRA and then convert into a Roth IRA, so you can still lock in those after tax benefits. So for me, my Roth 401k, my Roth IRA, those are my favorite types of accounts for investing because it means I'm getting the taxes out of the way now. And when I go to retire, let's say I look in my account and I see it has $700,000. I don't have to do the math and calculate $700,000 minus the taxes that I'm going to owe. No, because I'm not going to owe taxes. The $700,000 is all mine because taxes were already accounted for, calculated, and subtracted and taken out of my account before now. And then the money was put in after it was taxed. So after tax is great to get taxes out of the way. Now, if you would like to actually keep all the money growing in your account because you think that your tax is going to be lower when you're older, or because you think taxes are really high right now, or you think that you're going to be in a lower tax bracket when you retire, there's a lot of reasons why some people go, no, I'd rather pay taxes in the future. Me personally, I'm in the base camp of let me pay my taxes now and get them out the way because I personally believe taxes are only going to go up. I know that there's been a little push in the short term to lower taxes for wealthy people, but how in the world can our federal budget continue to sustain the way it is? The interest on national debt is like one of the top four things that we spend money on in the federal budget every year. Like there's just no way with the amount of debt that we have and more debt that we're taking on with the changes that were made recently legislatively. Like I personally just cannot imagine a world where taxes are going down in the future. I think they're going to go up, me personally. So that's why I'd rather do after tax accounts. And then in terms of the contributions that you should be putting, if your company matches you at 4%, well, when you put in 4%, you're putting in 8% because you're going to put in 4 and then the company's going to add 4. So now your account has 8% of your salary, even though you only had to put 4. So it's basically a magical way to just double the amount of money in your account right away. So yes, I would say if your company matches you at 4%, at the very least, you should be putting in 4% so you can double it right away with their match. Then go to a Roth IRA and try, maxing that out if you can afford to do that. And if you still got money after that and you want to keep putting money aside for retirement, then you can come back and increase a little bit your 401k contribution. But I would say put in the 4%, get the 4% match, run over to the Roth IRA, try to max that out. And if you're done with all of those things, Then go to a regular brokerage account. That's going to be the next account type, the fourth account type. So we talked about interest bearing checking, high yield savings, 401k slash Roth IRA, which are retirement accounts. Now let's talk about the regular traditional brokerage, which is a taxable brokerage account. A lot of people don't realize how powerful this account is. And the reason why the taxable brokerage account is so powerful, yes, it's taxable, which is annoying because the Roth IRA is not. But that being said, when you look at the benefits of the tax category for capital gains tax, which is what you pay when you grow money in your investment account and then you want to take it out. So you have two categories. You're either going to be in the short-term capital gains tax or long-term capital gains tax. Now, if you left your money in there for the short term, it grew and then wanted to take it out, which would be less than 1 year, so 365 days or less, then that would be considered a short-term move. So you're going to pay the short-term capital gains tax, which is much higher. It's a really high interest rate versus, or it's a really high percentage of tax. Versus if you were to do a long-term capital gain, which means that you leave it there for more than 366 days, more than a year, you let it keep on growing, 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 growing. Then when you go to withdraw, you're going to look at a long-term capital gain tax. That is much lower. There's only 3 categories for that, and it's much lower of a tax. So you save a bunch of money on taxes by leaving the money in your brokerage account and just letting it grow. The longer, the better. Now, one thing people don't realize that the wealthy people love to do is they look at 2 different things and compare them. So let's say I put in $100,000 and it grew to $700,000, right? It's 7x in value. 600K is profits that I made in the market. 100K is the investment that I put in. I have to pay taxes on the 600K of profits that I made, right? That's the capital gain. The 100K I put in, that's my principal. That's what I contributed. But the extra 600K that grew in my account magically, that is a capital gain. That's profit. So it's going to get taxed if I withdraw it. But what if you don't withdraw it? This is where the wealthy people come in with their strategies and tactics that I've been learning about, right? They'll look at the account and go, what if I just don't withdraw? Then I don't ever have to pay a capital gain tax. I'll just leave it and let it keep growing and growing. With my children, with my grandchildren, with my great grandchildren will inherit these accounts and they will just never withdraw any money from these accounts. So they just keep growing. That 100,000 turned into 700,000. By the time your kids inherit it, it's 1.4 million. By the time the next generation inherits it, it's 2.8 million. And all the time, they've never withdrawn a dollar from these accounts because you don't have to withdraw at any time from a brokerage account. If it's a taxable standard brokerage account, there's no rule about saying you have to take the money out. Now, if you have a 401k, you do have to take the money out. Or if you inherit a Roth IRA, you have to clear it within 10 years. These rules don't exist with the brokerage account. So you could just keep on passing it down, or you could keep growing the money in there and not withdraw money from your brokerage account. Then what happens is you can do something called a SBLOC, securities backed line of credit. The line of credit, which is basically like essentially like a credit card where you can borrow money or like a personal loan, is backed by the securities, which is another word to say stocks and bonds, inside of your brokerage account. So if you have a balance of $700,000 sitting in your brokerage account and you want to borrow $200,000 from that account, you'll borrow it through a securities backed line of credit. You're borrowing it, instead of borrowing it from the bank, you're going to borrow it from your own balance of your, you're going to borrow it from the bank, but you're going to borrow it with the security, with the like, what is collateralizing the loan is going to be the money sitting in your investment account. So if you don't pay your loan back to them, they'll just take the money from your balance of your investment account, and then you are going to have to pay capital gains tax. So that's the risk you take there. But if it doesn't happen that way, a lot of wealthy people, what they do is they take and borrow a line of credit against the value of their account. So they might borrow up to 50 or 75% of the balance in their securities account, their brokerage account. And then what you pay to the bank when you do that is going to be whatever interest rate you pay on a loan. So if you have excellent credit, if you have 800 credit score, you're going to pay pretty low interest on that. So instead of worrying about the capital gains tax being 15 or 20%, you don't got to worry about that. You can probably be paying 6% or maybe 7% or even less to borrow against the money in your investment account. So you never ever even spark a capital gain tax. You never have to worry about paying those capital gains taxes on your profits. You just let them keep growing and growing and growing and growing in your account. That is called a securities backed line of credit, SBLOC, and you can use it with a regular taxable brokerage account, which means you just go to an investment bank, a brokerage firm, something like Vanguard, something like Charles Schwab, something like Fidelity. You create your investment account. They say, what type of investment account is this? You just say standard taxable brokerage account. This is not a retirement account. This is not a traditional IRA or Roth IRA. This is not account. This is not a 529. This is not any type of special tax advantage account. It's a regular standard brokerage, a taxable brokerage account. And a lot of people don't like that because they think, oh, it's taxable. Oh, it's a standard account, doesn't have any perks or benefits. Well, what you want to do is look into researching SBLOC, a security backed line of credit. But here's the caveat, here's the catch, which a lot of people go, okay, what's the catch? Usually you cannot even qualify for applying to this SBLOC, a securities backed line of credit, unless you have a balance of 6 figures. So your biggest goal should be, was a big goal of mine for a very long time, was to open and establish my brokerage account, which is a taxable regular brokerage account, and invest aggressively, cut down my spending, save and cut on expenses here and there, be a little frugal here and there where I could, increase my income, generate more money coming in, take some of that and invest, keep investing until I hit 6 figures in my brokerage account. Now I'm lucky I have multiple 6 figures in my investment account. So I know that when I want to use money for something and I don't want to have to pay capital gains tax, I can just do a securities backed line of credit. But I'm not going to do it yet because I really want to make sure before I do that. In case my balance goes down, let's say the stock market isn't doing so well, my balance goes down, I'm not going to get to a point where they're going to have to force me to sell investments to pay back the loan. I really don't want that to ever happen. So the only way I can make sure that doesn't happen is if my balance is so high that even if it were to drop 20 or 30%, I would still have enough to cover that line of credit or the amount of money that I borrowed from against myself. So that is the reason why a regular taxable brokerage account, in my opinion, is extremely underrated. People be hating on it so much. And even me, like I pump up the Roth IRA way more. I'd be like, Roth IRA is the GOAT. And I'm always talking about the Roth IRA. But you can definitely use a taxable brokerage account. Stevio, I see you on Instagram, said taxable brokerage account could be used to retire early. Absolutely, yes, yes. Or you can use the rule of 55. Absolutely. All of these things I would say are things that definitely, you got to make sure you pay attention to if you're trying to hit these milestones that I would say like are really, not that easy. All right, let's see. On YouTube, we have set it to after tax. I like to set it to after tax for all of my accounts. For my Roth 401k, my Roth IRA are all set to after tax. How does pre versus after tax impact your taxable income? Excellent question. So basically, if you do anything pre-tax, it's going to be subtracted from your taxable income. So if you use a traditional IRA, if you use a regular 401k, these accounts, when you put money in, whatever total balance you put in, contributions that you put in will get subtracted from your taxable income when you go to file your taxes. But if you use after tax accounts, so Roth 401k or a Roth IRA, when you go to file your taxes, you're going to be paying taxes. So you're putting money after you pay the taxes into the account. So those are not going to get subtracted or deducted because then you're going to go back to not paying the tax because they're subtracting it from what your taxable income is. So in order to make sure it is truly after tax, they can't give you a tax deduction. They can't subtract it from your taxes owed you from the income that you're going to get taxed on. You have to pay taxes on that. So you will not lower your taxable income when you invest in a Roth IRA or a Roth 401k. It will do nothing for your tax savings in the short term. But in the long run, when you're in your 60s, your 70s, and you're going to go withdraw money, you will not have to worry about paying taxes at all. So it is going to do a huge tax benefit for your future self, for your 50, 60, 70-year-old self. And so that's what you have to weigh. You have to weigh, do I want to do a huge tax favor for my future self? Or do I want to do a huge tax favor for myself right now when I go file my taxes and I want to lower my taxable income because selfishly I want to pay less taxes right now? Maybe that's because you have debt you want to pay off. Maybe that's because you want to save more. Maybe it's because you want to give money to your kids or your family. Whatever the situation is, if you're trying to lower your taxable income now, you're trying to pay less taxes right now, which means you're going to pay more taxes later. So you're either going to pay the taxes now or you're going to pay the taxes later. Either way, you're going to pay the taxes. The only way to not pay the taxes is to use a securities backed line of credit and borrow money against your own securities balance in your investment account and pay interest on the loan and not pay taxes on withdrawing the money. But the reality is most people, it's really hard to hit six figures into your investment account, first of all. And second of all, most people have a 401k or an IRA. And eventually, you have to start taking withdrawals out unless it's a Roth account. So like a Roth IRA, there's no required minimum age, but you have to start taking money out. But if you have a 401k, the traditional 401k or traditional IRA, those do have RMDs, required minimum distribution, which means essentially required minimum age where you have to start taking withdrawals out, which sucks because like say you're 73, 74 years old. If you want to just leave the money there for your grandkids, you can't. You have to start taking a certain amount out because of the age that you are. So I personally like the Roth IRA so much because it doesn't force you at any age to start taking out withdrawals. So you could just leave it, let it keep growing and pass it down to your kids as generational wealth, which is, what I plan to do. I have 10 nieces and nephews. I have a huge family. There's plenty of people in the next generation of my family to be able to pass this money down and help them to establish their wealth and be able to buy a home, be able to live well. I don't want to be the only one living well. So if you're thinking about generational wealth, Roth IRA is a great generational wealth building tool. And the standard taxable brokerage account is also a great one because you can just leave the balance to keep growing and take out securities backed line of credit against it. Instead of having to take out money from it, you can let it keep growing and then pass it down to the next generation. All right. Thank you. I see in the comments. Thank you for the questions. These are really good questions. All right, y'all. I'm going to share the last account that I really, really love. And then I'm going to pop off and go enjoy my Saturday. And I hope that y'all do too. But let me look at some comments real quick. Johnny's back. Hello from Charlotte. Go Bushwick. Thank you for always sharing great information and the passion that you demonstrate. I think some people out there really think this is like a boring topic. And so I'm just trying to prove them wrong. There's nothing boring about this. There's nothing boring about talking about money, talking about investments, talking about wealth generation, talking about being strategic about, your future. Like this is the new cool and the new sexy. So matter of fact, it's always been cool and sexy. So I personally just want to bring my passion to show you it doesn't have to be dry and boring the way some people make it out to be. Clarissa, is all your money in one or two of these accounts, or is all your money diversified in other different accounts? Clarissa, great question. For me personally, I never have more than 1 or 2 months of earned income sitting in my interest-bearing checking account. I never have more than 6 to 9 months of income sitting in my high yield savings account. I have no maximum that I want to put and always have account, which is a taxable investment account. And right now I max out as much as I can. I'm allowed to put legally into my Roth IRA and my 401k. So, and the last one, which I'm going to talk about, which is the health savings account as well. So anytime there's a cap or a limit on it, I always hit that limit. So with the Roth IRA, I max it out every year. 401k, I max it out as much as I can. Then when I look at the standard brokerage account, there's no limit. So I just try as much as I can to constantly every month, every week be adding more money to it. I just want to keep growing it and growing it and growing it. And eventually my goal is to set up a securities backed line of credit so I can borrow against the value of my account. And with my checking and savings account, I generally do not have more than 2 months in my interest-bearing checking account and no more than 6 to 9 months of income in my high yield savings account. The only way I would change that is if I had the goal to like buy a property, for example, and I want to be cash heavy. Whenever you're going to look at buying a home, buying a rental property, buying any type of real estate, you got to be cash heavy. You can't be at a situation where you have most of your money in the market, because at any point the market could go down. We can't predict the future. We don't know what's going to happen. And if the market goes down by 40% or 30%, and now a huge chunk of your money is just poof gone, your account balance, you're going to be panicking because now you won't get approved for the property because your assets have decreased significantly. So you don't want to be playing those games. When you're going to get into the real estate market, whether that's for a home that you're buying or a rental property that you're buying, you got to be cash heavy until that purchase is closed and finalized. So the only way I would change up my kind of my rule that I have for my accounts is if I was specifically trying to be cash heavy so I could put a down payment on a property, or so I could pay closing costs, or whatever the situation may be with the real estate property. But right now I'm not looking into real estate at this moment. So 1 to 2 months in my checking, 6 to 9 months in my savings, max out my 401k, max out my Roth IRA. and everything else as much as I can into my regular taxable investment account. Now, in anything that allows for investing, so my Roth IRA, my 401k, my standard taxable brokerage account, and my HSA, which is my health savings account, which we'll talk about in a moment, all of those, what I buy with the money that I deposit in there is always low cost ETFs and low cost index funds. I have so many other videos, and the entire 8th chapter of my book, Mind Your Money, is all about investing in the stock market, how I do it, which is passive investments through low cost index funds and ETFs. This is, something that is tried and true. All of the statistical research, all of the different studies have shown that this is the best way to invest over the long run. So it saves you money. It maximizes your possible performance because it reduces the fees that you're paying. And when you look at who performs better, active people that are actively trading and buying and selling, constantly trying to beat the market versus a low cost index fund, low cost index funds win 90% of the time historically. So why would I pay more for something that does worse 90% of the time? That's dumb. So me personally, I love the passive investment strategy. So inside my 401k, my Roth IRA, my taxable brokerage account, and my health savings account, all the cash in there just used to buy more shares of low cost funds. Some of my favorite funds that I buy, VTSAX, which stands for Vanguard Total Stock Market Index Fund, VOO, which is Vanguard's version of the S&P 500 index fund, or it's an S&P 500 ETF. So it's an index ETF. And then I also really like to buy, if you have, depending on which account you have. So if you have an account with Fidelity, which a lot of my family members that I've helped them open their accounts, there will buy FXAIX and FZROX. Those are the ticker symbols for low cost index funds and low cost ETFs that will allow you to track either every single stock in the United States stock market that you are able to buy. That's the total stock market index. So that would be like VTSAX and FXAIX. FZROX. And then if you rather just get the 500 large cap leading stocks in the US, so 500 only instead of all 4,000 plus, then you would get the S&P 500 index or ETF, which would be something like VOO or FXAIX. These are hands down cheapest, easiest ways to get started investing in a passive index or ETF that gives you the maximum diversification that you can have, meaning you literally own the small stocks, the middle cap size stocks, the large stocks. You own them all. You own the financial, the tech, the consumer staples, the consumer discretionary, the healthcare, the real estate, the industrials. You own all of the sectors and the industries in the stock market. So that's my favorite way to invest. All right. Investing within your HSA is what we're going to talk about next. Astivio, that's coming up before I wrap up today. Clarissa said, I'm so sorry if it's a dumb question. I'm so financially illiterate. Tears. No, girl, don't be sad. There's no such thing as a dumb question. What is a good starting point for someone who's just starting to learn? I would say, Clarissa, the easiest thing that I did when I started learning was I started to listen to a few different financial podcasts. Every day I would listen to just one episode, and a few really good ones that I recommend that you start listening to. One of them is Yo Quiero Dinero podcast with Janice Torres Rodriguez. Another one that I really, really like is Jamila Sufrant. She has a podcast which is called Journey to Launch. I just started listening to episodes of these podcasts and literally just started to become obsessed with the stories of how everyday people who did not come from rich families were getting serious about paying off their debt and saving money and starting to invest. Another one that I really like is The Financial Diet. They have one called Financial Confessions, which is a YouTube and regular podcast. So yeah, just start listening to podcasts. And then of course, I'm going to plug my book, Mind Your Money. There's so many other books like my book that are basic, like financial literacy 101 books. But for somebody like you who said, oh, I'm so illiterate, I'm just starting, my book is like a really good first book to read because it covers all the basics, starting with your mindset, then going to banking, then going to budgeting, how to make a basic budget, then going into credit cards, your credit score, how to pay off any debt that you have, and investing. So it's really the basics. We don't talk a lot about like estate planning or insurance or tax strategizing. That's kind of like the next level up. But right now, you just got to master banking, budgeting, saving, and investing. Those and credit. Those, I would say, the first 5 like basic levels. So grab yourself a copy of my book. You can get it at mindyourmoneybook.com. You can get it at Barnes. You can get it at Target. You can get it at Amazon, anywhere where they sell books. Thrift books, if you want to support local bookstores or thrift bookstores. Mind Your Money. That's definitely what I would recommend, Clarissa, to just get started. Clarissa said, and then which banks do you use for these different accounts? So for the interest bearing checking, I have Ally. For my high yield savings, I have a cash savings account with Wealthfront. For my taxable brokerage, I use Vanguard and Fidelity. For my 401k, I have Vanguard. And what other accounts do I have? That's pretty much it. For my family's savings and checkings, I have Ally accounts for all of them. And for my nieces and nephews, for their custodial brokerage accounts, they're either at Schwab or Fidelity. So those are the institutions like I generally would recommend. All right. Do you have any 529 plans? I personally don't. LL Cam 2005 said, do you have 529? I don't have any 529 plans in my name, but all my nieces and nephews have 529 plans. And I love 529 plans, especially with the new changes that are happening because of the new bill that was passed that's changing all of these rules about like accounts, different account types. For 529 plans, it just doubled how much you can put in. So you used to only be able to put 10K. Now you can put in 20K. And depending on the state you live in, you may actually be able to write it off your contributions when you write when you do your taxes. So you got to look into which state accounts allow you to do that. But also the real thing I love that has changed is in the Secure 2.0 Act, which started in early 2025. If you have a 529 plan for your kids, if they decide when they get older, that money over into a Roth IRA up to $30,000. So that alone is amazing, because chances are if one of your children decides to go to college, then you just change the name on the account to their little brother or little sister, so you can still use the money for college. And then any money that's left in the account, you can roll it over to a Roth IRA. Like, it's a win-win-win-win. Like, that's amazing. So I would definitely recommend having a 529. If you don't know where to go to open one or how to start, I think there's a website that I love, like I recommend, is my529plan.com. My529plan.com is a great resource. Also, UGift allows you to you can just go to ugift.com. It allows you to set it up so that you could create a code. Like, your code could be like BEA51. Everyone that uses the code BEA51 can put money into the 529 to help you contribute to it. So, for example, if your child's birthday is coming up, you could send a letter to the whole family or send a text to the family, an email, and say, hey, fam, this year we're not doing birthday presents at all. We're going to ask you whatever money you were going to spend on the birthday gift, instead to deposit it into their 529 plan. Here's the code BEA15. So everybody goes to ugift.com, clicks on it, types in that code, and they'll see the child's name, and they can deposit money from their bank account straight into that 529 plan. So the whole family can help that kid start saving and investing money for their education. And eventually it could go to a Roth IRA. So I love 529 plans. Stevie O said, I really did pour my heart and soul into that book, y'all. Everybody keeps asking me, girl, when is your second book coming out? I'm like, second book? Hello, you know how much work it was to make the first one? I'm like, I'm still trying to recover, even though it came out in 2023, right? It's only been out for 2 years. Give me a break. Eventually, I'm sure I'll have a second book in me. But right now, I am still recovering from the process of writing a 241-page book. It's a lot of work, y'all. It's a lot. Okay, let's see. Bronx Mama 6 said, would you recommend a financial advisor as a good resource? How do you know which firm or financial advisor is best? Any recommendations? All right. I'm going to take this last one from IG, and then wrap up. You know what, Bronx Mama, I would say to you, financial advisors are on a very wide spectrum. There are some that are incredible, great cost structure, very fair and very helpful and well-intentioned, and they're going to hook you up. Then there's others on this side of the spectrum that are real freaking slick. They charge you crazy high fees that are not fair. They try to make it sound like it's not a bad deal when it is. And they sometimes have hidden fees, or they might be getting commissions that you don't know about. And on top of that, when they're promoting products to you, it might not even be the best thing for you to buy, but they're just trying to do it because they make profit or commissions whenever they add more people into those investments. So it runs the gamut, which is why I generally would say the only type of financial advisor you should work with is a fee only fiduciary. And if you can find advice only advisor, That's the best type of advisor. I know it's a mouthful. I know it's a lot to remember, but the first part is fee only, which means they do not get paid from commissions that they get. Like when you go to the shoe store and you're like, oh, I'm looking for a pair of sneakers that this color or that color. When they sell you a pair of sneakers and you go to pay for them, they go, did somebody in the store help you today? You go, yeah, Janelli, she helped me to find the sneakers. Then Janelli's going to get a commission for that sneaker sale, right? That means that they're going to be more incentivized to really push you certain shoes that will pay them commission. That's the same thing with investments. They're going to push certain investment products to you that they all get commissions from. You don't want that. You want them to only recommend products to you that are actually right for you, not because they're getting commissions. So fee only means no commission. If you see it says fee based, no, because fee based means that you pay a fee, but they might also have other ways they're getting paid too. No, fee only is the only type of fiduciary that I would trust. Fee only fiduciary, because fiduciary is the oath that they have to take saying that they're going to give you advice that is best for you and not that they're going to benefit from financially in any way. So fee only fiduciary. And then, of course, advice only means that they are not a wealth manager. They're not the kind of person who's going to say, just give me the money. Like, you're going to give me access to all of the money that you want to invest. I'm going to invest it for you, and I'm going to manage your investment account. I don't like that because it takes the work off of you, and it means that you're not doing the work or keeping an eye on it. They're doing everything. So I personally don't like that because it means that you're not learning, first of all, because they're doing everything and not you. And second of all, they could be doing something dishonest and you wouldn't really know because you don't have access. You're just getting statements every quarter. And most of the time, you don't even really look carefully at the statements because you trust that this person is doing the right thing. I would start by learning the basics yourself so you can talk to an advice only fiduciary advisor who will give you advice about what to do, where to go, how to open the account. They'll literally sit with you on Zoom, share your screen, and they'll tell you step by step what to click, what to buy, how much to put, where to put it. They'll hold your hand like a baby through the entire process, but they're only giving you advice. You're not paying for them to do the work. You're doing it, and they're giving you advice on how to do it. So that's advice only financial advisors. I respect them the most. If I ever sit with a financial advisor, it's going to be a fee only fiduciary advice only financial advisor. There is a website that my good friend Jeremy Schneider created Personal Finance Club, which is a social media platform, also a blog, and he has incredible resources. He hired a team to basically help people learn about personal finance. He sells courses, all kinds of stuff. Jeremy's great. And if you go to his company, he has another company that he created, which allows you to basically go and see a list of all the different financial advisors that you could work with that are advice only advisors. And these are CFPs. So they're financial planners as well. They can give you a holistic advice about everything, not just investments, taxes and savings and your kids and everything. And so the website for that is Hello Nectarine, nectarine like the fruit. So if you want to try that, I think it's like either $150 to $250 you pay to meet with them. So it's kind of like paying for a therapy session, and you sit down with them virtually on the computer. They'll meet with you, and like I said, they'll take your hand and guide you through every step of the process. Ask them anything. There's no such thing as a dumb question, and they're there to give you advice, solid financial advice, because that's literally their financial professionals that are certified to do this, and they're not managing the money for you. So you pay a flat dollar amount and you don't pay them again after that, unless you hire them again. So when you have certain financial advisors, they charge you 1% or 2% of your account balance, or AUM, which is called assets under management. That means as you make more money, they still take that same 2%, but the dollar amount is going up and up, because 2% of 100 is way more than 2% of 10. And 2% of a million is way more than 2% of 100. So as your balance grows and grows and grows, they make more money for doing the same thing. What other job do you make more money over time just because more money is coming in? Not when you do the same job every single time. It's the financial industry has gotten away with this for so long, and now we're starting to wake up to this and go, wait a minute, that don't make no sense. They're making so much profit off of us, and instead of that money staying in our accounts and growing, they're subtracting it for these fees. And at the end of the day, we could be talking about hundreds of thousands, if not millions of dollars, depending on your account balance. So I would not work with somebody who charges AUM, assets under management. I would never pay AUM fee. I would only work with somebody who is fee only, who is advice only. And if I get to the point one day where I have like $250 million, fingers crossed, and it's just too much for me to manage, then at that point I might get somebody to manage the money, but I would still get a fee only person, not an asset under management. I just don't think it's fair. So that's me. All right. Can you repeat the accounts, please? Yes. Account number one, interest bearing checking account. So it means you get paid interest for the money in your checking account. Two, high yield savings account. Three, 401k or Roth IRA. So a retirement investment account. Four, standard taxable brokerage account. So an investment account that is taxable, doesn't have any tax perks like your retirement account. And the fifth and final account is a health savings account. Now you have to check to see if you qualify for this because you need to have a high deductible health plan, HDHP. I happen to have that, so I qualify for an HSA. And basically, it's a triple tax advantaged account. When you put the money in, you're putting the money in pre-tax, so you don't so you get like a tax break for the contributions that you put in. Then, as the money grows, any profits that grow in the account are also going to be tax advantaged. And when you take the money out, any withdrawals that you make are tax advantaged. So you have a lot of tax advantages in one tiny, mighty little account called the health savings account, which is specifically for health, of course. So that means there's qualified medical expenses that you can take the money out to use it for without having to incur any taxes. That would be something like paying for prescriptions, paying for co-pays, paying deductibles, paying for doctor's visits, paying for, anything related to your health. That's a qualified expense. That being said, I personally don't use the money for medical expenses. I use the money to invest it in low cost index funds and low cost ETFs because a health savings account only requires you to have some amount of money in cash and then the rest you can invest it. So I invest the rest of the money I put into low cost index funds, low cost ETFs. And then over time, once you turn, I think it's like 65, if I'm not mistaken, you can basically use that money for anything. It doesn't have to be for medical expenses anymore. So at that point, it just becomes extra retirement money. So for me, I'm like, oh, that's really nice. I'm basically giving myself another buffer of extra income in retirement or extra money that I can use to travel or to just enjoy myself once I'm 65 years old. So I use the HSA that way. I know a lot of people do use it to pay for their ongoing health costs or medical needs. Me personally, I'm very fortunate that I'm in good health and I don't necessarily have to pull out the money a lot. The only thing I really do spend a lot of money on throughout the year is my dentist appointments and my glasses because I don't want to get LASIK yet. Maybe one day I'll change my mind, but I'm scared. So right now I just keep paying for glasses every couple of years. So that to me is like the only time where I'm really, and I just pay out of pocket for those things. I keep the receipts. Eventually in the future, if I need to get reimbursed for it, I can get reimbursed out of my health savings account. But right now, I really just want to let that money grow and grow and grow in the market. So that is the fifth and final type of account that I think are the best, most important top financial accounts that you need to have. Some of them are bank accounts, some of them are investment accounts, but all of them allow you to grow your money so that you are combating and fighting against inflation. That's the key here, right? A lot of them have tax benefits, tax perks, right? Where you can write off the contributions on your taxes or deduct the amount of money you contribute off your taxes. Some of them don't. So it's not always about the tax deduction in the immediate future. It's really about the long game and really growing wealth over time. So thank you everybody who tuned in live. This was a very long live. I'm already over a minute and I got so many questions both from Instagram and YouTube. It is going to be recorded. It is going to be on my YouTube channel. So if you missed it, you want to go back to any of the first segment of this, just go to my YouTube channel, Miss Be Helpful, and you can play the live there. All of my lives that I do are always going to be living on my YouTube channel. So you can catch them if you miss them. And if you have a question or a comment or something that I didn't really get to address today in my live, pop it into the comments or DM it to me. You can also email it to me, missbehelpful@gmail.com, and I'll make sure to address it in tomorrow's live because I'm live every single day. Sometimes I miss 1 or 2 days, but not on purpose. I try very hard to go live every single day so you have constant chances to come access this, ask me questions, have a conversation in the chat, learn from each other, learn from me. And I'll see you guys on the next live, which will be tomorrow. And